If you've blown an account or you're stuck at the same balance for months, this might hurt a little. It's not your entries. It's not the market. It's not bad luck. It's your risk. And the scary part, you probably think your risk is fine. You say things like, I only risk 1%. I follow my rules. I just had a bad week. But if I open your trade history right now, would I see the same risk on every trade? Or would I see tiny risks on average setups and bigger risks when you feel confident? Be honest, because that small shift, that tiny inconsistency, is exactly what keeps traders stuck for years. In this video, I'm going to show you the real risk management framework that professionals use, not the Instagram version, not the motivational version, the boring, repeatable system that quietly builds accounts. And once you see it, you won't be able to unsee it. When most traders start, they think the problem is the strategy. So they change indicators, switch time frames, buy new courses, backtest new patterns. But here's the uncomfortable truth. Most strategies with proper risk control can make money. Most traders with poor risk control will lose, even with a good strategy. Studies on trading performance show something simple. Win rate alone doesn't decide profitability. Position sizing does. You can win 40% of your trades and still grow. You can win 70% and still blow up. The difference? Risk structure. Professionals think like casino owners. Amateurs think like gamblers inside the casino. Risk management is not just putting a stop loss. It's a full structure around your behavior. It answers, how much do I risk per trade? How much do I risk per day? When do I stop trading? How do I scale up? How do I protect profits? If these numbers are not written down somewhere, not in your head written, then your system is incomplete. And incomplete systems break under pressure. You've heard this before. Risk 1% per trade. But here's what nobody explains. It's not about the number. It's about consistency. If your account is $10,000, 1% is $100. That means every trade risks $100, not $100 on normal setups, not $200 on A-plus setups, not $50 when you're scared, exactly $100. Why? Because risk consistency builds statistical clarity. Let's say your strategy has a 50% win rate with 1 to 2 risk to reward. Over 100 trades, 50 losses equals minus 50%. 50 wins equals plus 100%. Net result equals plus 50%. But that only works if risk is consistent. If you double risk on losers and shrink it on winners, the math collapses. And most traders don't notice they're doing this. Here's the pattern I see over and over. A trader says, I follow my plan. Then, 2 losses happen, confidence drops, risk shrinks. Then a winner comes. Small size, then confidence returns. Next setup looks amazing. Risk increases, loss hits, account drops hard, and the trader says, I just had bad luck. No, you had inconsistent risk behavior. That's the silent account killer. Not the strategy, not the spread, not the news, you. Now let's talk about the real power move. If you risk 1%, you should aim for at least 2%. That 1 to 2 ratio changes everything. Why? Because now you don't need to be right all the time. Example, 10 trades, 4 winners, 6 losers. Risk 1%, reward 2%. You lose 6%, you gain 8%, net plus 2%. You were wrong more than right, and still profitable. This removes emotional pressure. You stop trying to be right. You start trying to follow process. And that shift is massive. Even professionals have bad days. The difference? They stop. A simple rule. If you lose 3% in a day, you're done. No exceptions. Why? Because after multiple losses, you trade to recover, you move stops, you enter early, you overanalyze, your brain shifts from logical to emotional. A daily stop protects your capital from your psychology, and trading is more psychology than strategy. Here's the real shift. Struggling traders focus on this trade, today's result, this week's P&L. Millionaire traders focus on the next 100 trades, the next 6 months, capital preservation first. They think in probabilities. One loss means nothing. One win means nothing. Only long-term execution matters. When you start thinking like that, you stop chasing, you stop revenge trading, you stop fearing losses, and your equity curve smooths out. Not because you found a magic setup, but because you stop sabotaging yourself. If you take nothing else from this video, remember this. Consistent risk creates consistent results, not perfect entries, not high win rates, not confidence, consistency. And most traders don't fail because they risk too much. They fail because they risk differently every time. Fix that, and everything changes. Watch the next video on your screen if you want to see how traders unknowingly train themselves to lose. Because your account is yours. Your growth is yours. Your mistakes are yours, so protect it, control it, respect it. Trade like you plan to be here for a long time, and one day, you won't realize when it happened. You'll just look up and see how far you've come. Peace.